Okay, I hope you could watch that video, but this whole idea of buy-side brokerage is something that just fascinates us, and if you're interested in that, I'm going to put my email up at the end of the session. Shoot us an email. We'd be happy to chat with you about it. So the next topic I want to talk about is the idea of Class A versus Class B, right? We're talking about what should you buy. Should you just buy Class A or should you just buy Class B? Well, let's think about this, okay? So let's define Class A as generally newer properties built, after 1990. They tend to attract more under 30 people. Maybe might be better said between 25 and 45. Generally, they're higher income and without empty children and then some empty nesters. These also have, nice amenities, and it's a positive demographic and things like that. So what we found is that in a strong economy, Class A tends to outperform. So when the economy is booming, you can raise your rents on these Class A people more just because they've got the disposable income. This is someone that we would call the lifestyle renter, right? So Class A shows more upside, but it also shows more downside when the market is turning around. Because if you're a renter at $250, they've got a $2.50 to $2.50 per square foot. They've got a long way to drop. Right? If your rents are $1.30 or $1.40 and the economy turns on you, there's only so far that rents are going to fall. So market timing on Class A is probably more critical. On Class B product, let's just call that older product built before 1990. That attracts more households, many single parents or people with lower incomes. The lower rent is competitive with with for sale product. They can't afford it, and so potentially there's less turnover. So the risk is that when you're competing with Class A product, you've got these higher capital costs, these probably higher losses and things like that. And what we found is that Class B falls less in the early stages of the downturn. So really what I'm saying is that if you look at it historically, Class A product has more volatility, but it can move up faster. It can also move down faster. Class B typically tends to fall less, especially in the early stages of the downturn. So from that, you say, well, what's the strategy? Well, maybe you buy both, right? In general, during periods of economic prosperity, Class A will outperform, Class B, but during times of weakness, Class B will tend to outperform Class A. Sometimes if there's a lot of Class A, it can just drop and then really clobber the Class B. But I think overall, national investors or people looking for diversity would probably benefit from a portfolio, not just from a mix of markets, so not just from being in different cities, but also having an asset class a difference in those cities. So you'd be across the country and you'd be in Class A and Class B. Gary, I think at this point you want to say something?